Hello everyone. In previous lecture, we have discussed about some of the ratios. Now, what I will be covering some other important ratios to analyze the balance sheet. So I will be shared with you. Yeah. So you can see here. Now we are discussing about financial stability ratio. Now, what actually is financial stability ratio, right? So it talks about basically the items of balance sheet, right? It will be comparing. Last time we have seen that we were comparing P&L and balance item, that is sales versus asset, sales versus equity, right? Now here we will see that how balance sheet items are to be compared and what result you will be getting here. So first ratio is total debt to equity ratio, right? Now what total debt to equity ratio talks about, right? So you can see formula is same, right? Debt to equity ratio, formula is debt upon equity, right? Now basically it will tell proportion, right? It will tell you the proportion, that what is the proportion of debt and what is the proportion of equity, right? Now here in balance sheet, we have seen that what is the proportion, what was the proportion of debt and equity. Here we have seen the total of shareholders fund, that is going to be equity. The total of shareholder fund was how much? It was 19,055, right? And total of debt fund was how much? It was 19,485. Okay, it was 19,480. So this is the total of debt and this is the total of equity, right? So you can see that is more than equity. Right? Here you can find out that that is more than equity, right? So in this case, we will see what is the debt equity ratio. Debt equity ratio is 1.14, right? So what is the formula? Formula is debt divided by equity, right? This is the formula. So let's suppose if company has issued shares of equity shares of rupees 100 crore. So with the help of this ratio, if I have to find out the debt, so what is going to be the debt of company? So obviously debt of company is 1.14 times as compared to equity, right? So if equity is 100 crore, so debt is going to be 114 crore. This is going to be the total value of debt, right? So what is going to be the formula? Formula is going to be debt divided by equity. So that is 114 crore here, and equity is how much? It is 100 crore. So it is going to be 1.14 times, right? You can see the values here and you will be getting the idea, right? You will be getting the idea, right? So now if I talk about the next ratio, that is current ratio. Now what is current ratio? Current ratio means current asset divided by current liability, right? Now basically, in our case, we have seen that company is having more current liability as compared to current asset, right? Company's current liability is more than current asset, right? We have seen in previous lecture. Now, why we calculate current ratio? What is the reason why we calculate current ratio, right? Basically, we are comparing current asset and current liability, right? Now, what is the reason why we are comparing current asset and current liability? Just because if company is not having sufficient current asset, what is the meaning of current asset? Current asset basically means debtors, right? From debtors, company will be receiving the money in future, right? Definitely, if you are selling some goods on credit to your buyers or client, certainly within 60 days or within 90 days, what they will be doing, they will be making the payment to you, right? So from debtors, you will be receiving the cash. Cash includes cash and bank balance. Current asset includes cash and bank balance, right? It means you are having cash money with you, right? It includes loan and advances also. So if you have given some small loans to some other companies or other parties, right? So you will be receiving the cash in future, right? It includes marketable security also. Current asset includes marketable security also, right? So here, with the help of this issue, you will be able to find out that whether company is having sufficient cash with them or not. Why? Because definitely if you are having current liability with you, here company is having more current liability as compared to current asset. So definitely in future, what creditors will do, they will demand the money, right? If you have taken short-term loans, what bank will do? Bank will call back their money, right? Now if you're not having sufficient cash then, if you are having cash crunch, so definitely you won't be able to pay amount to creditor. You won't be able to pay the loan, right? You won't be able to repay the loan which you have taken from banks and financial institutions. Now, what banks or financial institution or creditor they will do? They will file a case against you in court, and it will affect your goodwill. Even though if you are not able to repay the money for a long period, so there are chances court may ask you to sell your company and repay the debt amount, right? So that is the reason when you are investing your money, you should check current ratio, right? If you see the current ratio of company is 0.6, right? It means if I take example here, so let's suppose current asset and current liability value is given. Let's suppose current liability is 100 crore and current asset is 60 crore. What ratio you will be getting here? Here you will be getting 60 crore divided by 100 crore. That is going to be 0.6. right? So what is current ratio here? Current ratio is 0.6. It means your liability is of 100 rupees, right? Your liability is of how much? It is 100 crore, and you are having a current asset of 60 crore, right? So in future, there are high chances that your company will be seeing problem, right? So that is the reason what accounting body says that the standard current ratio is 2:1. It shows that companies should have double current asset as compared to their current liability. Right? This is the standard current ratio. Right? So at least it should be one. Right? I'm not saying that companies should have 2:1 ratio, but at least it should have equal or more current asset as compared to liability. Right? This is about current ratio. Now we'll be discussing about quick ratio. So we have seen the formula of current ratio. What is the formula? Formula for current ratio is current asset divided by current liability. What actually is quick ratio? And it is also known as asset test ratio. So first of all, I will be writing down the formula here. Formula is quick asset divided by current liability. Right now, you can see the change in this formula. Previously, we have written current asset for current ratio. Now we are writing quick asset for quick ratio. Now, what is the meaning of quick asset? Right? So if I talk about current asset, so current asset includes cash, right? It includes marketable securities. It includes debtors. It includes inventory, right? It also include prepaid expenses, right? This is what a definition of current asset, right? Now, and I have calculated the current ratio. What I will be doing, I will be including all the items of current asset, right? In current ratio when I will be calculating current ratio, right? So here, current ratio includes all these items, right? But if I talk about quick ratio means it talks about more accurate cash results, like how much company is having or how much company is able, what kind of assets company is having, which can be converted into cash quickly, right? So here, in case of quick ratio, what we'll be doing, we will be ignoring inventory and prepaid expenses. Why we will be ignoring inventory and prepaid expenses? Because if I talk about inventory, see, it is not possible for company to sell inventory immediately and to receive the cash. Suppose Tata Motors, they are having raw material with them. They are having glasses, they are having steel, they are having plastic, they are having music system with them. So it is not possible for them to immediately sell the raw material. First, they have to convert raw material into WIP, then into finished goods, and then they will be able to sell those goods in market. Right? These are not easily convertible assets, right? Current assets. If I talk about prepaid expenses, if you have paid advance electricity, if you have paid advance tax, so you can't convert those advance tax and advance electricity bill into immediately, right? So that is the reason for quick ratio calculation, we will be ignoring inventory and production. So it will be giving you better quick cash result, that how much cash company is having to pay the creditors on time, right? So if you see here, so what is the quick ratio? Quick ratio is 0.48, right? Why this current ratio is more than quick ratio? Because here this ratio includes inventory and prepaid expenses, right? So we won't be including now prepaid expenses and inventory. So we'll find that if we want to check the accurate cash, so accurate cash of companies 0.43 here, right? It is 0.43, right? So formula is going to be quick asset divided by current liability, right? So further things we will be discussing in coming lecture. In next lecture, I will be discussing about profit and loss account, how you will be preparing the profit and loss account, and how you can analyze the P&L account. In coming sessions, I will be taking different sectors, and at the end, we will be comparing all the sectors, right? So what is the difference in sectors we will be discussing in next lecture. Thank you, and stay tuned with us for more and better learning.